Good morning. This is the 11:30 panel, and we will be discussing RWAs. And yeah, I like that. Thank you, Tom. We'll be discussing RWAs, and the question we've been asked to discuss is whether or not we are just moving the existing financial system onto new rails, or whether we are building something entirely new. And we have an amazing panel here to discuss it. We have Barbara Pozdorovkina from LMAX Group. We have Ben Elvidge from TriliTech, Andy Kangpan from Metalayer, and Kathleen Wrynn from Invesco. So we have a great set of perspectives. We have an exchange operator, we have an allocator, we have a builder, we have a large asset manager that's very involved, who I understand actually just got off a call with a large trade association talking about tokenization. So these are all folks who are deeply involved in RWAs. Of course, I think as all of us are familiar, the growth in RWAs, both in terms of the outstanding assets in RWAs, which has tripled from last year to this year, and the movement has really become an important part, not just of the crypto ecosystem, but of broader strategies that asset managers and broker-dealers are pursuing. So I think we have a really exciting opportunity to talk about that today. First, though, I'd like to ask each of you to introduce yourselves, and if you could also talk a little bit about your firm and how you're interacting with RWAs and tokenization now. I think that would be great. And Barbara, I'll start with you.
Great. Teddy, thank you very much. Great to be here. I'm Barbara Pozdorovkina. I'm Chief Growth Officer at LMAX Group. As an exchange and cross-asset infrastructure operator, our clients trade both traditional and digital assets across our exchanges. And these clients are some of the largest banks, non-banks, asset managers, and brokers. So today, I'll be discussing trading of tokenized RWAs and benefits of tokenizations as we see as an exchange operator, as well as I'll talk about some infrastructure gaps and issues around liquidity which still exist.
Yeah. Ben?
Brill. Ben Elvidge. I'm got two roles. I'm head of alternative assets at TriliTech, which is the adoption hub for the Tezos ecosystem, based out of London. But in terms of RWAs, my day job, I guess, is I run our metals.io business, which is tokenizing metals. Kind of does what it says on the tin. We started with uranium. So uranium.io was the platform last year. We evolved that into metals.io in March of this year, and we have a roadmap and vision for lots of other tokenized metals specifically. So yeah, exciting times.
Amazing. And Ben, just to share a little light for the audience, so what are the other types of metals? Are we talking about like big gold, silver, or are we talking about other types of things?
Yeah, I think there's two parts to our business. So we really see the opportunity in base and industrial metals because they've been hard to access historically for most investors. But the other part to our business on metals.io is more of a front-end aggregation. So when you go onto metals.io, we do also have other projects. So we've got a gold token on there, and we've got a rare earth metals basket as well. So there's two parts to our business, both the issuance and the creation that's focused on those base and industrial metals, and then other metals that other people are already doing because, quite frankly, there's enough gold tokens out there that we didn't see the value in building that from the ground up.
Fascinating. Andy?
Hey everyone, my name is Andy Kangpan. I'm one of the co-founders of Metalayer. Metalayer is a digital asset investment firm. We operate a mix of early stage private investment strategies and also have a trading arm. We're a spin-off from a larger investment manager called 2 Sigma. So we interact with RWA space in a few different ways. On the venture capital side, we've invested into a number of startups that are building actively in the RWA ecosystem. On the trading side, we actively hold and trade many of the tokenized assets that are on-chain today. And then we also work as a partner to many tokenized asset issuers on various capital markets related challenges.
Fascinating. Kathleen?
Hi, great to be here. Kathleen Wrynn, Global Head Digital Assets at Invesco. Invesco has been involved in digital assets since 2019, more on the crypto exchange traded product side of things. So we have several crypto ETPs in Europe and the US. But I joined about a year ago to create a dedicated digital assets team for the firm to really take our efforts and make them much more scalable. So while we're continuing to launch crypto-linked products and traditional wrappers, for the past year we've been very focused on tokenization. And so we're excited to announce early last month we took over Super State's USTB product, which is a tokenized short duration U.S. Treasuries fund, looking to build out more other tokenized capabilities across different asset classes and regions going forward as well.
Wow, fascinating. So as you can see, we have a bunch of different perspectives here, and we'll hear from all of them as we talk a little bit about this question. I think a good place to start is to level set on where we are now. So what's happening with your businesses now? Where are we? What are your clients doing? And let's give the audience an understanding of where we think we are in phase. So maybe, Barbara, I'll start with you again. Could you talk a little bit about, as an exchange operator, as an infrastructure provider, what are you seeing now? What are clients doing with RWAs? If you know, why are they doing it? And what are you seeing at the current moment?
Yeah, absolutely. Well, tokenization, I mean, it's about real-time ownership transfer, and that is very important for real-time capital mobility and capital efficiency in the ecosystem. So obviously the benefits that we're seeing that clients get from trading tokenized assets is the 24/7 market access, it's the faster settlement times, and it's the real-time collateral mobility. And all these benefits become even more acute during the times of high market volatility. So as an example, during first half of this year, during the geopolitical driven market volatility events, what we've seen in traditional financial markets, investors couldn't get out quickly enough of some of their positions. And so their positions were closed, or they missed on the opportunities to deploy capital where the market opportunity was. So in those instances, it was gold and oil. So those that were trading the tokenized gold and oil, they were able to benefit from that real-time collateral mobility. And this is key. And I think tokenization actually highlights the structural problem in traditional finance, which is the risk doesn't moves faster than the underlying collateral that supports it. And of course, tokenization solves that problem. So if we're able to deploy the capital at the same rate as the market risk moves, the whole system becomes more efficient. So this is a big benefit. And again, we've seen it real time during the high market volatility events that we've experienced this year.
Fascinating. So you see that the collateral mobility, the 24/7 nature of these assets, very different in that regard.
Absolutely, yeah.
Fascinating. So Kathleen, I want to go over to you and talk about, I think you touched on it a little bit in the opening, right? Bringing tokenized products into traditional wrappers. Now for the last year, being a little bit more focused on actual tokenization of existing products that you have. Can you tell us a little bit about, from your perspective, from Invesco's perspective, massive platform, traditional manager, can you talk a little bit about where you see the industry is right now and where Invesco is on this journey?
Yeah, absolutely. Maybe helpful to hit on kind of both topics. So I think when we think of crypto-linked products and traditional wrappers, there's a lot of evolution happening there as well. I think thinking of the ability, thinking of crypto TPs specifically, in-kind redemptions, enabling staking, maybe lending opportunities, the ability to launch more innovative products through the generic listing standards. There's a lot of innovation happening there, which is very exciting. But also on tokenization, that's where really as an industry, I think we have agreed that there is product market fit for tokenized money market funds. I think it's very clear how, from cloud mobility, payments perspective, there's clear use cases, stablecoin reserves. I think what we need to do as an industry now going forward, though, is create more use cases for additional asset classes and also across other jurisdictions. So I think thinking of traditional asset management to be institutional grade solutions, there are so many different expertise across, again, a different asset class, and that varies by region usually as well. And so to get the dozens of groups that we need to be part of successfully launching a tokenized product, you have to upskill them as well around digital assets. And so that's what's happening now. I think a lot of education, but also figuring out where those opportunities are, because if you're going to tokenize a product, it needs to be a net better product than the traditional version that exists in our view. And so whether that's net new utility or net new product features, think of our tokenized short duration product, instant redemptions, continuous NAV. These are net better products that exist because of tokenized format.
Yeah, and that's sort of interesting in the context of the debate we're to have here on the stage, which is like, are they net better, or is it just like tokenization is all the rage, so we're tokenizing them? Can you just pull on that thread a little bit more? What those net better product features can be because of tokenization?
Yeah, I mean, the ability to be on-chain and be programmatic, you're unlocking whole new features. So thinking of, maybe the 100 roles and responsibilities that exist in the traditional format, it's working with these experts across every function, with investment risk, compliance, legal, all these different aspects, to say, why is this monthly? Can it be daily? Can this be automated because it's on-chain? So really kind of reimagining and making the existing products more efficient, with the goal longer term to be making much more scalable solutions.
Fascinating. So, Andy, your perspective, both you shared with us, both investor, allocator, supporting some early stage companies that are working on this. What are you seeing now in terms of the ways that RWAs are actually being used, either in your portfolios, the way that your clients are building them before? How are they being used now?
Yeah, I think maybe I'll share two things there. So one is from the venture capital perspective. A company we invested in, our protocol is called 3F Labs. So they're trying to make RWAs usable for a DeFi native audience. And so for folks who are active in the DeFi space, like one of the active strategies that people tend to run there is like a yield loop, where you collateralize an asset, borrow, and then invest that back into the asset. So you basically get like leveraged yield exposure. But doing that with a permission tokenized asset today is extremely painful because there's settlement delays, there's lack of liquidity around the actual borrow-lend protocols. And so 3F makes that a one-click process where you can take a tokenized asset like USDC or USTB or others, compose it with the protocol, and you instantaneously get leveraged yield on that. And so there's a wide number of protocols that are in the DeFi ecosystem today that are trying to integrate those tokenized assets so that they're usable within the crypto audience today. On the trading side, we're active holders of many of the assets. We're actually one of the larger holders of USTB. And it's particularly compelling for us because we want to be active in the on-chain ecosystem. Historically in crypto, there are very limited things that you can get exposure to that are relatively risk-free. Even though they, like many things on crypto, look risk-free, there's obviously a lot of counterparty risk. There's a lot of smart contract risk. There are things that are hard to price.
Yeah.
And so being able to deposit into treasuries is actually a really big unlock for us that can help us unlock additional yield on idle funds when we're running systematic strategies, and be a little bit more comfortable around the actual risk that we're taking. So that's been a really big unlock for us on the trading side.
Yeah, this is a really interesting one because it kind of dovetails with what Barbara was talking about. Can you say a little more about the difference between what existed before and using a tokenized version of a money market fund, for example? Like what's different now in your ability to use USDC or USTB, click allocate, you have the exposure right away. Talk a little bit about the differences there from, obviously you came from Two Sigma, more traditional background. Can you talk a little bit about that?
So in the crypto context, if we want, some of the strategies we run, for example, they're like long bias strategies. So we want to get exposure to crypto assets, but in market regimes where we've determined there are not sustained upward trends in the market, we'll typically be risk off. So we'll hold stablecoins as a result. We don't want to move those stablecoins off. It's difficult to move those stablecoins off exchanges or off chain in a way that allows us to capitalize on opportunities very quickly on chain. And so we want to keep it on chain. And then historically, the ways in which we would get yield would be like deposit into a stakehouse vault or deposit into other types of sort of yield opportunities on chain that looked on the surface relatively risk-free because they were like it was exposure to over-collateralized lending. But you don't really get, at least from our perspective, compensated enough for the smart contract risk, the risk you're taking with the vault curators, relative to the yield you could get just from allocating into treasuries. And so that's been really big for us and just feeling more comfortable with managing our idle balance.
Fascinating. So Ben, we talked a little bit about collateral mobility, tokenizing existing funds. Andy shared a little bit about his strategy and why tokenization is more efficient. I think you have a little bit of a different angle than the rest of the panel, given the types of exposures that you've been working on tokenizing. Can you talk a little bit more about what that journey has been like to get to this point of having these types of assets tokenized?
Yeah, I think just rebuilding, I think as the panel's framed, feels like quite a safe narrative, right? Because it's sort of like, well, we know how to deal with, instruments that are risk-free and make those more mobile, make those more accessible, make those trade more frequently, and that feels like quite a safe narrative. But for us, as we looked at it, actually the real value in tokenization is in the sharp end of actually rebuilding market infrastructure or building market infrastructure for the first time that doesn't exist. So you make it accessible. Uranium's a great example of that, right? Where the market before we launched trades on a paper-based predominantly system. It's OTC. There's about 12 desks globally that can run physical uranium.
Wow.
And it's a 10 to 15-day settlement cycle in the physical market. And so actually taking that, putting it on chain and being able to trade it and settle it in a matter of seconds completely can transform that market, we would argue. And, we're starting to see now we've got almost a 2-year track record that the institutional demand that's been latent around getting clean exposure to physical uranium, given its links to AI and nuclear power and all of those macro tailwinds, is something that people are looking to do and see what we've built as a mechanism to do that. But it's been a long journey, and I think the journey was 2 years before I even joined the project, so I got the fun bit of coming in for the last 6 to 8 months to build the product, but the legal thinking around that's critical. And then the real work then started, which is, as many folks on this panel and in the room will know, it's the distribution side that actually is the hard work from then on, and we still continue on that path.
Yeah, wow. And so from that perspective, then it does sound like, Ben, the narrative from your perspective is this is an entirely new thing.
Yeah, it is. But I think the challenge is for a lot of institutional allocators and institutional players in the room and on this panel, those markets where you can actually have the biggest impact are so small relative to the size of the treasury market or the money market funds market. So if you're weighing up and having to go and stake, bad word perhaps, but stake your reputation on doing tokenization, you're going to start with the less risky, I would argue, assets and bigger target addressable market assets.
Right.
But in terms of, as we look at it, from our kind of DNA coming from being an adoption hub for the ecosystem, how do you demonstrate the most value of blockchain technology? We would argue it's in these markets that are currently opaque, illiquid, inaccessible, where actually putting these assets on chain breaks down those barriers and can bring capital allocation to markets where they otherwise previously wouldn't have had it.
Fascinating. And Kathleen, I'm interested in the Invesco perspective on this, kind of getting a little bit further into the question that we have to answer today. When Invesco sits around the strategy table and thinks about the long-term vision here, would you characterize it as this is the next improvement of how our financial system works? Or do you think that the understanding is this is actually an entirely new thing that we're building as we embark on this project?
Yeah, this is a structural shift in how asset managers are going to operate over time, and that's why for Invesco, this is a strategic priority for the firm. Because while it's going to take time and it will happen, it's not an either or, I think. It's very much like efficiency gains with ultimately unlocking brand new business models over time, but that's still very much in process. So I think thinking of, what something that is really needed right now is more coordination. I think as an industry, thinking of traditional financial markets, they are incredibly interconnected. When it comes to where we are right now with on-chain markets, there's a lot of fragmentation and not portability across different jurisdictions, and that needs to change. And I think that what's happening is really great in terms of all the coordination that is actually happening in real time. So thinking of this past week alone, DTCC launched their tokenized pilot program for their tokenization service with 7 use cases across 30 different organizations. Really successful. I think also the Investment Company Institute, ICI, published a tokenization white paper highlighting kind of shared or regulatory principles for policymakers to consider. Also in the UK, the Wholesale Digital Champions Group published a paper. So a lot of great coordination to kind of foster that interconnectedness more. But we need more regulatory clarity to broaden more ecosystem interconnectivity to unlock that.
Yeah, and I want to pull on this thread a little bit too, which is, I mean, I'm going to come to you on this one, Andy, but Kathleen mentioned a few of the areas: regulatory clarity, coordination and fragmentation, distribution, products themselves. What do you think is holding back? Obviously, we've had amazing success in just the last year. What do you see as the things that are going to be holding back the continued development of RWAs coming on chain?
I think regulatory clarity is still the biggest impediment to the space. I mean, I think these folks probably know better than I do, but the amount of like hurdles institutional market participants have to go through to do things on chain today in a compliant way is absurd. And I think it's just trying to retrofit old regulations into a very different capital market ecosystem. And so I think there needs to be a much more clear and a much more innovative regulatory stance around what's happening in tokenization. Because I fundamentally believe it's a once in a generation capital markets innovation that's going to drive significant amounts of growth for not just the crypto ecosystem, but the financial services industry broadly. And that's going to be really driven by institutional market participants. Like institutions drive most of the flows in financial markets. And by and large, most of these institutions aren't really doing as much as they could be in crypto. And I think a lot of that is because the regulatory stance is very unclear still. And so the Clarity Act would be great. And then I think there's still even beyond that a number of issues that need to be worked through. But I think that is still the biggest impediment.
Yeah, and Barbara, from your perspective, you're sitting in the middle, you're seeing clients trade, allocate, use collateral. Is there something that you think is holding back even further growth here? Is it proliferation of more products? Is it more types of products?
Well, the biggest blockers that we see as an exchange operator, and I think that the panel has already alluded to that. So one is obviously issues around credit risk. So there is limited credit intermediation today available for trading digital assets, and that just affects how capital efficient the trading environment is. So that's a big issue. And then the second blocker is, of course, the interoperability of the existing infrastructure, and that creates issues around frictionless access across the system. And then altogether, it's about liquidity. So as an exchange operator, we're in the business of providing deep institutional liquidity to our clients. So if we don't have that liquidity, we don't see the adoption of RWAs becoming at scale. So really, we need to solve for all the infrastructure gaps that you guys alluded to. So we need to solve for institutions to enable broader participation, broader distribution, and then we're going to have that liquidity that we need for the market to grow further.
Yeah, and from where does that come from? Does it come from the client demand side for more products first? Does it come from the supply side with more products that are available? Does it come with market makers being able to price these things more accurately? Is it a combination of them?
Well, I think it's complex, right? It's chicken and egg, but looking at the infrastructure, looking at limited credit intermediation available, issues around infrastructure gaps and fragmentation, that's actually something that we could fix as an industry. And a lot of lessons could be learned in business practices from traditional finance. And then, of course, different tokens have different underlying liquidity. So there's also a question of liquidity there. But, we think that solving as an exchange some of the infrastructure gaps that's possible today. And, back to credit intermediation, we already started working with some of the top tier one banks about developing credit intermediation solutions. So more recently, we've announced that we've tested with Standard Chartered, tested their prime brokerage model for digital assets, combining execution on our exchange. So that's a very significant milestone in the industry, which will unlock the more capital efficient trading of digital and tokenized assets. So industry exchanges can do a lot to address the infrastructure.
For sure. So I only have a couple of minutes left, and I have more questions that I want to ask. But a thing that I wanted to ask you, Kathleen, in light of what Barbara shared, is does Invesco think of what you're building with tokenization as responding to client demand now? Or is it more that you believe that there's a strategic motion towards this happening in the future and it's inevitable and you're building towards that future? Is there a balance there? Can you talk about that a little bit?
Yeah, absolutely. So I think when it comes to kind of like crypto ETPs, traditional wrappers, that's very much, I think, traditional clients want to gain that exposure. When it comes to tokenized solutions, it's very much in a lot of ways a new market where it's a lot of the on-chain native investors who want to hold, like Metalayer, these types of solutions. And so that's where it's exciting thinking of building our client base to service these clients going forward as well, and building out our capabilities there. So we know over time, those markets are going to converge, and there will be more interest and adoption of tokenized products. But right now, it is in a lot of ways a new market.
Yeah, and Andy, I see you nodding your head there, but the venture investments you talked about a little bit, how do those entrepreneurs think about the size of the market? Do they think that the TAM is coming for all assets? Or how are they visualizing the types of businesses they could ultimately become in terms of total addressable market?
Yeah, I think the founders that we're backing in the space have a shared perspective to ours in that tokenization is a generational innovation. And I think if you take the very, very narrow view of what tokenization is today, you're not going to get that excited about it. And in the same way that when ETFs in the US launched in the 90s, it was a wrapper that allowed a small subset of institutions to trade an index in a much more efficient way. So looked at it in like a very narrow way. I don't think that was very exciting.
Right.
But you fast forward now, I think the majority of US investors get access to equities through ETFs. I think it surpassed mutual funds, or if not, it's like on par. So I think tokenization is coming for all assets. If you look at the ETF complex today, you not only had net new companies emerge, but you have ETF desks at every single large financial institution. And collectively, these market participants generate billions of dollars in revenues every single year. And I think that's what's happening in tokenization. So I think people are just taking a very narrow view of what's happening today. And so the founders we're backing think about it in a 10-year time horizon where the market is going. And we try to, when we try to partner with founders, we look for those folks who have a shared worldview in that way.
Fascinating. All right, I'm being given the high sign to wrap it up, but I'm going to try to do one quick rapid fire question for each of you. I'll ask the same one. Ben, I'm going to put you on the spot here first. In the next year to 18 months, what is one big development or the biggest development that you are looking forward to or that you think is going to be the most important in terms of us taking the next step forward?
So I'll stay in my wheelhouse, and my hope, and hopefully we're a part of it, is having a major clearinghouse move beyond tokenized money market funds or treasuries for collateral, and actually being able to take tokenized commodities as collateral.
Right.
That, in our world, opens up a whole different spectrum of investors and participants that we can target. So that's what I'm hoping for in the next 12 to 18 months.
Centralized clearinghouse. All right, Barbara, what do you think?
Well, more top-tier banks offering credit intermediation for trading digital and tokenized assets, and that will unlock the market growth in our view
All
and
right,
make it more capital efficient.
We've got top-tier banks doing credit intermediation, centralized clearinghouse. Andy, what about for you?
This is the most important development that can happen.
Yeah.
Clarity Act.
Clarity Act. Kathleen, to wrap us up.
I think finding new utility for new asset class, finding product market fit on chain. So tokenized exchange traded products, tokenized private credit, beyond seeing what's worked on tokenized money market funds, building upon that.
Amazing. Well, thank you all. How about a little round of applause for our panelists here?